post-money versus pre-money valuations, the real truth. Welcome back to DevLand Startup School. Today, we're demystifying one of the most fundamental yet frequently misunderstood concepts in startup financing, pre-money and post-money valuations. By the end of this session, you'll understand not just the definitions, but the profound implications these numbers have on your ownership, dilution, and fundraising strategy. The basic definitions. Let me start with the textbook definitions before we dive into what really matters. Pre-money valuation is the value of your company before new investment comes in. Post-money valuation is the value after the investment. The relationship is straightforward. Pre-money valuation plus investment amount equals post-money valuation. If your pre-money valuation is $8 million and an investor puts in $2 million, your post-money valuation is $10 million. Simple arithmetic, profound implications. Hashtag why this distinction matters. Here's where founders often miss the forest for the trees. These aren't just accounting terms. They fundamentally determine how much of your company you're selling. When an investor says they'll invest $2 million at an $8 million pre-money valuation, they're buying 20% of your company. The math, their $2 million divided by the $10 million post-money equals 20%. But if that same investor offers $2 million at an $8 million post-money valuation, they're buying 25% of your company. The pre-money in this case is only $6 million. This difference might seem small, but compounded over multiple rounds, and you've given away significantly more of your company than intended. The evolution of market standards. The venture capital industry has undergone a subtle but important shift over the past decade. Historically, VCs quoted pre-money valuations. Today, especially since the rise of safes and convertible notes, post-money valuations have become more common. This isn't arbitrary, it's strategic. Post-money valuations provide certainty to investors about their ownership percentage. With a post-money safe, investors know exactly what percentage they're buying regardless of how much other money comes in before conversion. This shift transfers dilution risk from investors to founders and existing shareholders. Common misconceptions and traps. Let me address the most dangerous misconceptions I see founders make. First, comparing valuations across different structures without understanding the underlying math. A $10 million post-money safe is not equivalent to a $10 million pre-money priced round. The safe might seem simpler, but you're likely giving up more equity. Second, focusing solely on valuation while ignoring other terms. A high pre-money valuation with a large option pool increase might leave you with less than a lower pre-money valuation with a small pool increase. The option pool shuffle, where investors require an option pool increase before their investment, effectively reduces your pre-money valuation. Third, misunderstanding how convertible instruments work. When your safe or convertible note converts, the discount and valuation cap create their own dynamics. A $10 million post-money cap with a 20% discount means early investors get the better of buying it. $8 million or the price round valuation minus 20%. The option pool shuffle. You negotiate a $10 million pre-money valuation for a $2.5 million round. You expect 20% dilution. But then the investor requires a 15% option pool. The higher the team you'll need. This pool comes out of the pre-money valuation. The real math, your effective pre-money becomes $8.5 million, the $10 million minus the $1.5 million option pool value. The investor still puts in $2.5 million, but now owns 22.7% instead of 20%. You've given up an extra 2.7% of your company. This deserves special attention because it's where sophisticated investors often outmaneuver first-time founders. Here's how it works. Safes and the post-money standard. Why Combinators moved to post-money safes in 2018 fundamentally changed early-stage financing dynamics. Under the old pre-money safes, subsequent safes diluted earlier ones. This created uncertainty for investors but preserved more equity for founders. Post-money safes provide investors certainty, but stack dilution on founders. If you raise 3 post-money safes at different valuations, you know exactly how much you've sold, but it's often more than founders expect when they actually do the math at conversion. Real-world scenarios. Let me illustrate with actual scenarios I've seen. Scenario 1, a founder raises $500,000 on a $5 million post-money safe, then another $500,000 on a $6 million post-money safe. They think they've sold about 17% total. But at conversion, they've actually sold 18.3% because each safe independently calculates its percentage. Scenario 2, two competing term sheets, both for $3 million. One offers a $12 million pre-money, the other a $15 million post-money. The founder almost takes the $15 million because it's a higher valuation. But the first offer actually values the company higher at a $15 million post-money versus the second's $15 million post-money, where the pre-money is only $12 million. Scenario 3, a strategic investor offers a high pre-money valuation, but requires a 20% option pool increase and has a participating preferred liquidation preference. The headline number looks great, but the effective economics are worse than a lower valuation with clean terms. Negotiation strategies. Understanding these dynamics gives you leverage in negotiations. Here's how to approach them. Always clarify whether quotes are pre or post money. Never assume. Ask explicitly and get it in writing. When comparing offers, convert everything to the same basis. Create a spreadsheet showing exactly how much equity you're selling under each scenario. Negotiate the option pool separately from valuation. Push for the pool increase to be counted in the post-money valuation, or negotiate for a smaller increase with refreshers at later rounds. Remember that unused options come back to all shareholders pro rata, so a large pool isn't necessarily bad if you have discipline about grants. Consider the total round dynamics. If you're raising from multiple investors, understand how their investments interact. With safes, this is particularly important as the order and structure can significantly impact dilution. Pre-money versus post-money isn't just accounting terminology. It's the foundation of how equity ownership gets allocated in your company. The difference between understanding and misunderstanding these concepts could cost you significant ownership over your company's lifecycle. The shift from pre to post-money standards reflects broader power dynamics in venture capital. In founder-friendly markets, pre-money valuations and other founder-favorable terms proliferate. In investor-friendly markets, post-money structures and investor protections increase. Building your intuition, terms can matter more than price. A clean term sheet at a moderate valuation often beats a complex one at a high valuation. Liquidation preferences, participation rights, anti-dilution provisions, and board composition all impact real outcomes more than headline valuations. The truth about valuation. Always model the fully diluted impact of any financing before agreeing to terms. Never compare valuations without understanding the complete structure. Build your cap table model early and update it continuously. Get comfortable with the math. This is too important to delegate entirely. As you prepare for fundraising, remember these crucial points. Practical takeaways. Play with the numbers until the relationships become intuitive. This understanding will serve you throughout your fundraising journey. Here's what I wish every founder understood. Valuation is just one variable in a complex equation. The highest valuation isn't always the best deal. Consider these factors holistically. Understanding these dynamics helps you gauge market conditions and negotiate accordingly. When capital is abundant, push for pre-money valuations and founder-friendly terms. When capital is scarce, you might need to accept post-money structures, but can still optimize within those constraints. Conclusion. When someone quotes a valuation, immediately ask, is that pre or post? When raising on safes, understand whether they're pre or post money and model the conversion scenarios. When negotiating priced rounds, separate the option pool discussion from the valuation discussion, the macro view, the international perspective. Next week, we'll dive into liquidation preferences and why a one-times preference isn't always as simple as it sounds. Until then, master these valuation concepts. They're fundamental to every other fundraising decision you'll make. The real truth about valuations is that they're just numbers until you understand what percentage of your company you're selling. Focus relentlessly on ownership and dilution, not abstract valuations. Build your intuition through modeling and never sign anything until you understand exactly how much equity you're exchanging for capital. Different geographies have different conventions. Silicon Valley has largely moved to post-money standards for early stages. European investors often still quote pre-money valuations. Asian markets vary by country and stage. When dealing with international investors, never assume they're using your local convention. For your homework, I want you to model your current cap table under 3 scenarios. raising your next round as a pre-money priced round, as a post-money priced round, and as a post-money safe. Calculate your resulting ownership in each case. The differences might surprise you. To truly grasp these concepts, you need to model them yourself. Create a spreadsheet with these scenarios: a priced round with various option pool increases, multiple safe rounds converting at different prices, comparison of pre-money versus post-money safes with identical caps, the impact of discounts on convertible note conversions. Dilution is what matters, not abstract valuation. Track your cap table religiously. Understand fully diluted ownership, including all options, warrants, and convertible instruments. Model scenarios before you negotiate, not after.